Now let's take an example. Assume that you signed a put option contract and the stock which is included in this put option contract is for a company called ABC. Assume also that you agreed on a strike price in this put option contract for this stock which is $55. Strike price means that if you would like to exercise the option and sell your stock on using this option or by exercising this put option, so you are going to receive $55 from the other party, which is the writer. Assume also that you determine the quantity in this put option, that it is 1,000 stock or 1,000 shares, 1,000 shares of stock of the company called ABC. Assume also that the cost to purchase this put option is $1,000. So the total cost of purchasing the put option is $1,000. If you'd like to calculate the cost of purchasing this put option per one share, so you have to divide the $1,000, which is the total cost, by the number of shares included in this put option contract. So the result will be $1 per share. This is the cost of the put option. Assume also that you agreed with the other party that the duration of this contract is 30 days. 30 days mean that if you would like to exercise this put option at any point of time during the 30 days, you have the full right to exercise this put option at any point in time during this 30 days. And this is American put option. It is not European put option, because American put option gives you the possibility of exercising the option at any point of time during the duration. But the European put option, you have to exercise, if you'd like to exercise, you should exercise at the end of the contract, which is the due date after 30 days, The purchase date of this put option, assume that it's 10th of June. 10th of June. This is the purchase date that we acquired this put option. Assume also on this date that the market price of this company stock was $50. This is the market price on this date. Now, the given information has been finished, and we need to start analyzing and understanding the put option. The first thing that we need to do is to calculate something called the break-even price. Break-even price, this is the price that you are going to start achieving some gains. Let's understand how to calculate, and let's understand the meaning. The break-even price is the difference between the exercise price that you are going to receive if you exercise the option minus the cost that you already paid. Because actually, if you would like to exercise the option, you are going to sell this share using this option and receive $55. And already you paid $1 before per share. So the remaining net proceeds for you is considered as a $54. So this is the break-even price. Now, if you are the buyer of this put option, and you know that the market price, for example, is $30 in the market for this stock. So the question here is, if you would like to sell this stock, are you going to sell in the market and receive $30, or you are going to exercise the option and receive $55? Definitely, you are going to exercise the option and receive $55. So now you can achieve gain. The gain is the difference between the $30 in the market and the net proceeds that you received from the exercising the option. The net proceeds is the break-even price, which is $54. So this is the gain and how it's calculated. And the same amount will be considered as a loss to the other party. Some people are doing very nice trading in this. For example, they don't have this stock at all. And then they are expecting or estimating that the stock price will drop down. So using a minimal investment like this $1,000, so they are going to purchase this put option because they have a high expectation that the price will drop down. So they set a price $55. Again, they don't have the stock and they signed a put option. They are going to start witness the market price for this stock during the 30 days. And then once they found that the market price of this stock is get below $54, so they are going to purchase this stock from the market. Maybe for $35, for example, or $30. And then on the same day, they are going to sell it to the the writer of the option. So they are going to exercise the option. So they are going to purchase the stock in the same day. Go to the writer of the option. Mr. Writer, I need to exercise this put option. Please give me $55. And then they can achieve the difference in terms of gain on the same day. This is how people are using the put option. Now, let's understand the scenarios that we have. We are going to work this case based on several scenarios. The scenario number one, which is after 1 month or during this month, we are going to assume that the market price of this stock is $40. The scenario number two, the second scenario, is $50. Third one is $60. Fourth scenario, $65. Fifth scenario, $70. So these are the several scenarios that we are going to work on in order to calculate the gain and loss. And I included all of these scenarios here in this nice chart. This is the purchase price, as you can see here, $50. So we have all of these different scenarios during the same period in order to calculate the gain and loss for each one. Now, let's compare between two things. If you didn't sign the put option, and you have the stock and you are going to sell it in the market, so you don't have any option. So we need to calculate the gain and loss here. Assume that you are working the traditional way of the investment without signing any put option. So you purchase from the market and sell in the market. So this is the traditional way of doing the business, doing investment in stock. The other way is to sign a put option, which is option number 2 here. So we need to compare between the risk and the loss and the gain on each one of them, based on all of these scenarios under each option. Okay, so this is the map on and what we are going to do during the next few minutes. Now let's start with the first option, which is the traditional way of doing the investment on stock, which is purchasing from the market and selling in the market without signing any put option, without even understanding the derivatives. Okay, so now assume that you purchase the stock from the market on $50, and now you are going to sell it based on the first scenario. The market price is 40. So the question here is, did you achieve a gain or loss? I purchased on 50 and I sold on 40, so I achieved the loss. The loss here will equal to 40 minus 50, which is the market price that you purchased on, times the number of stock that you purchased. So this is the total loss in the first scenario, which is $10,000. Okay, now if you would like to calculate the same formula for other scenarios, so we are going to make some absolute references here and looking some of the cells, and this will be the remaining gain and loss for the other scenarios. So in the scenario number 2, because actually you are going to sell on 50 and this is the same price that you purchased on, so you don't have any gain and any losses. But starting from scenario number 3, so you are going to start achieving some gains because the market price start to increase over than the purchase price that you purchased the stock. Okay, one more important information here. Some people might ask, okay, where is the broker fees and the commission fees? Actually, in this case study, I'm assuming that to ignore the commission, the broker commissions and the transaction fees. Actually, it's very minimal, but if you'd like to consider it, it will be losses. So in this case, for example, the result will not be 0, it will be negative for the amount of the transaction fees or the broker commission fees. Okay, now if you would like to calculate the percentage of your gain and loss, what you are going to do, I'm going to divide this loss by the total investment that I paid to purchase this stock from the market. How much did you purchase this stock? I purchased the one stock, one share bear $50. And how many shares? 1,000. So originally you paid 1,000 times 50 equal $50,000. And if you would like to calculate the percentage of the gain and loss, simply you are going to divide your loss and gain divided by the investment that you paid. So the result here will be 20%, and this will be the other gain and loss percentages for the other scenarios. Okay, before commenting on this first option, let's calculate the second option here, which I mean that to use put option and exercising bid option, and let's compare between the results. Okay, again the same scenarios, 5 scenarios, same market prices in each scenario. Then we need to calculate the gain and loss for this case. $40 and the big even price is 54. Okay, and the exercise price is 55. Now, if you have the stock in your hand and you have two options: to sell in the market and get $40, or to sell and exercise the option and get 55. Which one is more beneficial for you and much better for you? Definitely exercising the option and getting $55 is much better than selling in the market. So in this case, you have some gains. How much is the gain? The gain is simply the difference between the market price, the break-even price that you have for the option minus the market price here. And this will be multiplied by the number of stocks that you have, which is the number of shares in the contract. Now, this will result in $14,000 as a gain if you have the market price in the first scenario as $40. $14,000. You know how much did you pay in the beginning in order to acquire this put option? You paid $1,000. So $1,000 you paid initially, and now you get gain. You got a gain equal to $14,000. Do you know how much is the percentage of the gain? It is 14,000 divided by $1,000 that you paid in order to purchase this contract. So it is 1,400% or 1,400%. You achieved 14 times of your investment as a gain. So options as one of the derivatives is allowing you to achieve the fruit of the gains, to see the fruit of the gains, to achieve some gains. However, how much did you pay in the beginning? I paid $1,000. But in the first option here, how much did you pay? $50,000. So in the first way of trading, which is the traditional way, you paid the full investment, which is $50,000. But signing derivative contracts allow you to pay only $1,000. So paying $1,000, achieving $14,000 as a gain. So you are achieving a huge gain because of signing this derivative contract. This is number one. Number two, I expect more small investors will start trading in the stock market in Saudi Arabia because of this decision to launch or to start trading in the derivatives market. Because as you know, the derivatives market will require very minimal investment, which is $1,000 for example. But on the other hand, if you played it very well and the market reacted based as per your expectation, so you are going to start achieve gains for nothing with very minimal investment. That's why derivatives allow you to limit your loss. I'm going to tell you how can we limit our losses, and is achieving gains on a minimal investment. Now let's start calculating the gain and loss for the other scenarios. So we are going to compare again between this market price in the market and the exercise price. Definitely you have to exercise the option and get $55. So we are going to compare between the break-even price here minus the market price. All of these times the number of stock that you purchased. This will result in 4,000 gains. Starting from the third scenario, the market price is $60 and the exercise price is 55. So the question here is, which is more beneficial for you? Exercising the option and get $55 or selling in the market and get $60? Simply the answer is not to exercise the option but to sell in the market. In this case, you achieved a loss, and this loss equal to the amount of the investment that you paid originally to acquire or to purchase this put option contract, which is how much? $1,000. So we are going to say in this scenario, I will not exercise the option and I will lose the $1,000 that I paid in order to purchase this put option contract in the beginning. So this is your loss. Go to the fourth scenario, $65 and here 55. So which is more beneficial for you? Definitely the option, to sell in the market and get $65, not to exercise the option. So in this case again, because you paid the cost of purchasing the put option and you didn't exercise the put option, so you are achieving loss, and this loss equal to the amount of the investment that you paid in order to acquire this put option, which again will be $1,000. And for the last scenario, this will be the same loss, which is $1,000 again for the same reason. So look on the gain and loss here. Your loss is capped, has a maximum. You cannot exceed it. How much is the loss? How much is the maximum loss? This is the $1,000 that you paid originally. But how much is your gain? It is open. Open. you can achieve as much gain as you can or as you expect based on the market reactions on the market price. So this is the difference between the traditional way of doing the business on the investment and the signing of the derivatives contract. So you are doing some sort of jumbling here based on the market price, for example. How much is the percentage here? If you would like to calculate the percentage of the gain and loss, you have to divide by the investment that you paid. So here is the investment, that's the percentage of the gain and loss, and as you can see, the loss is maximum loss is 100% of your investment that you paid. This is from the buyer side. One more thing before finishing the buyer side, that we need to determine whether the contract for the buyer is in the money or out of the money. Simply, if the buyer is achieving gain, so the contract is in the money, he is achieving gain, he got a benefit from this contract. So as long as this is a gain scenario, so this will be in the money or in money. So this will be the type of the contract based on these gain and losses. But if the contract started to achieve losses, such as the third and the fourth, fifth scenarios, so in this case the contract will be out of money. So this will be out of money because actually the buyer bid something and he didn't exercise, so the contract will be out of money. Now let's do the same calculation here, but from the point of view of the seller or the writer of the contract, which is the other party. Now same scenarios and the same market prices, and we need to start calculating the gain and loss. We agreed before that the gain in one party equal exactly the same amount of the loss on the other party. So whatever gain the buyer is achieving, this will be considered as a loss on the writer side. And whatever loss the buyer is achieving, this will be considered a gain on the writer side. So look in the case here. The writer is charged or is having open risk, very high risk, because of the loss. The loss doesn't have a ceiling. He can lose big amount of money if the market price drop down too much below the exercise price in the contract. But on the other side, the gain is very limited and capped, and this gain is capped by the amount of the money he received in the beginning when he sold this contract to the buyer. So this is the difference between the buyer and the writer. Okay, let's now determine the type of the contract. Now let's determine the type of the contract of this put option for the writer. If the writer is achieving losses, so this one will be out of money. So he will say I'm out of money, or this contract is out of money because actually I am losing from this contract. And if the writer is achieving gain, so in this case it will be in the money. So the writer is getting a benefit from these contracts. In this tutorial, we explained the meaning and definition of the put option, how the process between the two parties is going on in order to close this deal of the put option. The put option have some components: the company stock name, the company name, the duration, the number or the volume and the quantity, the exercise price, and the cost to purchase this put option. The contract is between the buyer and the writer. The gain and loss in one party equal exactly to the same loss on the other party. If the contract in one party is in the money, so it will be out of the money for the other party. So this is the gain and loss and the payoff schedules and calculation for both of the parties. I hope this tutorial is helpful for you to understand how to get a benefit from launching trading in the derivatives market in the Saudi Arabia. Also, this tutorial is very important for CMA students part 2 because they are studying the derivatives market. Also, this tutorial is important for CTP professional students who are studying certified treasury professional certification, because this is part of their syllabus as well in this exam. I hope this tutorial is helpful for you. Thank you. Assalamu alaikum.